Good Monday morning, everyone. I hope to do this over the weekend, but time definitely got away from me. As some of you know, the Big East women's basketball tournament is at Mohegan Sun, where they had a slew of games on Saturday and on Sunday. Hey, go Huskies. And then the finals are tonight. So I was there watching basketball and I was only in the office, I think, Saturday morning. So in any case, let me talk about a few things today. I'm just going to set my screen up better than it is. So one, thanks for watching. I always appreciate the constructively critical commentary, as well as any questions, comments, or concerns. If you like the video and like what you listen to, see, etc., you can give it a thumbs up on YouTube. For those of you who are waiting from our spirits tasting last week, I promised the video would come out, the recording would come out the next day. My apologies. I screwed up because I logged on too early and it's got 10 or 15 minutes of me eating dinner and stuffing my face and looking worse than I normally do. So that will come out hopefully tonight, tomorrow morning. I need one of my teenage sons to edit it out for me. That's coming and I apologize. So let's dive in. The big question I've gotten lately, which is why I decided to do a video rather than posting the blog this morning, was how high is oil going to go? Usually when I get a cornucopia of questions on the same topic, I think it's pretty much widespread and pervasive question, comment, or concern. So over the last week, it's been oil. People are asking, can it go to 200 or 300? Where is it going? Why is it going? What's the deal? So I'm going to cover oil first. Probably, if I remember, I'll talk about gold a little bit. We'll go into the stock market and rate hikes, and then we'll close with a couple of tips on what you should be doing now, kind of big picture stuff. So let me dive in. This time, I'm not going to say this is a short, quick update because it won't be. So I do appreciate you listening, especially those who can endure me till the end of the video. Let's dive into oil. I'm going to share my screen and talk about some things going on. All right, here we go. So here is oil. Let me go back to a daily chart of oil. It's just easier because it's more short term. I guess my first comment would be, anyone looking at this can see that from the November lows, oil has gone straight up. Nobody can argue that. That's a fact. Oil has gone straight up from roughly 60 bucks to, actually, I think this morning, oil printed, I think it printed 130 this morning, 130 bucks a barrel. Is it an all-time high? No, it's not. In the summer, July of 2008, we saw oil hit $147. I'm going to get to that. So here I just want to show you oil has gone crazy. It's essentially doubled from the low in November. So now the controversial comment, which people will push back on. This is the kind of action in oil, in energy prices, you see near the end of a move, not at the beginning of a move and not in the middle of the move. At the end of a move, a commodity goes vertical. And unlike the stock market, which sees usually like some kind of W bottom, sometimes a V bottom, but oftentimes a more complex bottom, in commodities especially, you normally see V-shaped tops, upside down Vs. The commodity goes straight up, and then the commodity collapses because something changes, some dynamic changes quickly overnight. I'm not saying today is the peak in oil. Could it be? Sure, why not? But I think we're in that. If this is a football game, we're in the fourth quarter of the energy move. I don't expect oil to do this, to go down and then up and then down and then up and then finally go down. I do not expect that. I think we're in this, hyperbolic phase where it's going to go straight up to wherever it's going, and then it's going to peak. Maybe it's today or next week or next month. We're in that zone of the final peak in oil. How it shapes out, I can't tell you. I don't know what's going to happen with geopolitical events, but that's what normally happens. And I'm going to show you 2008 and 1990, just so that you don't think I'm making this stuff up, which I don't think anyone you do. But so so the chart of oil has gone parabolic, hyperbolic, pick your adjective, doesn't matter. Two, I don't want to get wonky and talk about term structure in oil, but if you are a commodities aficionado, you know about things called contango and backwardation. Don't worry about Googling it and trying to understand it. Sorry, I got something in my eye. But in essence, when oil is priced cheaper in later months in the year, and it's very expensive now, that's backwardation. When oil in contango, it means it's cheaper now and more expensive as you go out. When oil's in backwardation, meaning it's really expensive now and gets cheaper in months later in the year, that talks about supplies being tight right now and some kind of event going on. Again, I don't want to get wonky on you guys and you click off right now because you don't understand what that means. Just understand this. The price of oil right now is pricing in a squeeze, a supply squeeze right now that's not there in subsequent months. So we'll leave it there. All right, so there's our boom in oil. And I did a video, I can pull it up because I don't remember the date, doesn't matter. But here was where oil was minus 40 bucks a barrel. And I shared at the time, maybe I did the video a day or two later. Again, I can't remember, but I remember I called up my oil guy and I said that on the minus 40 day, how many gallons of home heating oil will you let me buy? Because I was ready to put up whatever they would sell me as long as I could use it over subsequent years. So, and I wrote about it. That was an easy one. Also, one of our favorite wrong way commentators on the day after oil was at minus $40 a barrel said, energy is uninvestable. Get that through your thick skulls. Energy is uninvestable. And he also said that oil would continue to trade negatively, and anytime it poked above positively, people would sell into it. Well, again, as you know from our writings, if you find these people who are almost, not always, no one's always wrong, but typically get big moves wrong, you can do really well. That same commentator in November said this was the peak in oil. I think it was $73. So it was right here. That was the peak in oil at $73, and oil had a little decline, turned tail, and then soared. So again, this is not an easy, and I know I make fun of people a lot, but I make fun of myself for making wrong calls. So this particular commentator is just habitually wrong, and it's fun. I think someone could probably create a product to go opposite many of his calls because they are certainly not wonderful. In any case, so here we go from minus 40 a barrel in oil to 130 bucks a barrel, all in what, under 2 years. Let's just run quickly back to 2008. So here's the peak in 08. Again, I said it was 147. I think that's probably accurate. And you'll see, the kind of the end, not as much today, but look, a lot of people called this the peak in oil right here. Late 07, early 08. And that's just not how commodities peak. Of course, I could be wrong, and this could be some kind of new paradigm for how commodities peak, but this is not how they peak. This is how they peak. They go straight up to wherever they're going. They put in their peak, and then so oil goes from $85 a barrel to 147 in half a year. And then it goes from 147. I won't bring us down to minus 40, but look, it goes from 147 straight down to roughly 35 bucks a barrel. And really the only rally was a 1 week rally here. It was really just an absolute straight down move crash for what's that? Less than a year in oil. Could that happen today? Sure. I don't know, but it certainly could. This would not be my preferred scenario, a straight down move. I don't think that's the case now. And if we go back to 1990, it took me a little while to get there, but thanks for your patience. What happened in 1990? We also had a little shock when Iraq invaded Kuwait. So here's the summer of 1990. Oil was $15 and change a barrel. In July, Saddam Hussein invaded Kuwait, and oil, I think, went to 30, if I'm not mistaken. Yeah. Oh no, I'm wrong. It's 40. So oil goes from 15 bucks a barrel all the way to $40 a barrel inside of, what's that, 6 months, 5 months. Again, just like we're seeing today, straight up move in oil. And then it peaks literally in the middle of nowhere. Never went sideways and gave you an opportunity, but it peaked at $40+ a barrel and then promptly sold off, quickly down to 18 bucks a barrel. So keep in mind the oil shock, if you're a consumer who uses oil to heat their house, it's already March 7th. So the heating season is almost over. The driving season's not. But this is what should happen towards the end of a run in energy prices. You get this big up move, and we should see the first move down pretty sharp, whether it's today, next week, next month. We're in that fourth quarter. So that's oil. Let me just quickly comment on gold and pull that up. In my 2022 fearless forecast, I had said certainly gold to 2000 and then likely to at least 2,500. So we started that, in here, and then where are we now in gold? Gold is 1980, so we're probably 2,000 bucks an ounce now in gold. I don't think the boom is over, but it's really hard when you see a move in gold from 1780 to 2000. It's very hard to advocate to buy gold here. More than likely, there'll be a pullback along with oil and the whole commodity complex. And it's going to be a pretty good one. Whenever that happens, it's going to be that inverse V, and they'll cut them loose pretty quickly. At that point, you can debate and decide if you want to hop on then. But I have a very tough time telling someone to buy gold at $2,000 an ounce when it just was at 1780 a month ago and change. Okay, so we did oil, we did gold. Let's talk about the stock market. So let me stop sharing for a minute. You can see my ugly face again. Stock market, just to reiterate, there's nothing new in my thinking other than, no, there's nothing new really. We came into the year, I thought we'd have down Q1, up Q2, down Q3, up Q4. That was the roadmap for the year, which sounds neat and tidy. The market never really accommodates. Sometimes they'll, like now, so we're down Q1, came into the year, I thought there'd be a pullback. I didn't think the magnitude would be as big as it is now. I thought it'd be a mid to upper single digit pullback. It's certainly a little bit more. Okay, magnitude, I'm not great at it, but we're okay. And this is all falling within the realm of the decline from the January 4th peak to January 24. That was the meat of the decline. I guess I can go back to the chart. The meat of the decline was, share this, January 4th to January 24th. This was the meat right here. We had a rally that I think we did a good job of saying this was going to fail, and it was a rally to sell. I was banging on the table, sell rallies, sell rallies, sell rallies. We had the decline into February 24th here. Where in normal times, I would have said this is the bottom on February 24th. And I've written about it a bunch of times. I said that what bothers me is, one, we have a Fed meeting. We know they're going to raise rates a quarter point on March 16. The market would have to completely unravel from here to stop Powell, and I mean completely, like down 25% from the peak, to stop Powell from raising rates. I don't think that's going to happen. But I really wanted to get to the Fed week, which is next week, to remove some more uncertainty for the markets. That's the bottom I would think we're going to go out of. So, January 24th, S&P got down to 4,200. February 24th, 41 and change. And right now we're still in decline. Where this bottoms, maybe we're going to come down again between 4,000 and 4,200. But these areas right in here seem like good places to accumulate if you're in that risk on mentality. I do not think we're going to completely unravel from here. Of course, if some lunatic launches some kind of tactical nuclear strike, clearly all bets are off. It's just not the likely scenario right now. So again, I'm trying to get to, we've had rolling periods of dry powder, and I will do an update on our strategies right after I do this one. But I just wanted to get to that March period. And someone said to me, well, what facts or data support that? And I said, and I wrote about it last week, none, zero. 32 years in the business, sometimes you have a feeling, which it's hard to trade on feelings, frankly. And I would say most of the time you would lose. Just my gut said there's something else about this bottom that wasn't so cut and dried. And I had said this bottom upcoming will not be an easy V like we've seen every time since Christmas of 2018. It was going to be more complex. Recent complex bottoms were January of 2018. So this was a complex bottom. We had the big decline here. We rallied, we came down again, we rallied. This was a very complex bottom and a little harder to negotiate. So that was a complex bottom. 2015 and 16 were complex bottoms. Let's take a look. So here is 2015 and 16. 2015 is right here. That was the China crash, a rally, and then we had a secondary low here. And then we also, this was made it really difficult because we rallied, stopped short of new highs, and came back down and put two more lows. And so this to me looked like a really complex 6-month period. And then 1994, I know we're going to go back a long way to 94, which may take me a little bit of time to get back there. But 94 had two things. One, it was a complex bottom. And two, what else happened in 94? The Fed raised rates. So here at 94, we peaked in January. Sentiment was crazy. Everyone was bullish. We really sold off hard into March. And then we put in a couple of other low attempts and then a better one in June. And then we had in November, if you remember, November, December, Orange County, California, the municipality went bankrupt. So this whole period, almost, 9 months, was a very complex bottom. And that led to the best year I ever had in the markets, which is 1995, where the market just soared. They were similar to 2019. So those are complex bottoms. They don't just look like a V and we go back to new highs. Let's go back to, so here we are. Also, let's remember the Fed's going to raise rates on March 16th. Similarly, the Fed in 2018, they were already raising rates, but other rate hike cycles, we had the 2015, the Fed started raising rates in December of 2015. That was in the middle of that 15, 16 very complex bottom in the stock market. The Fed was raising rates in 1994 all year. That one, the Fed shocked the markets in February of 94. Went to bed and woke up, they raised rates. That was a big shocker. And we had that real complex low too. So, rate hike cycle is here. There have been many, as you know, since Volcker left and Greenspan came in August of 87, there have not been many new rate hike cycles. I think you've got May of 88, February of 94, March of 97, June of 99, June of 04, December of 2015. That's a handful of rate hike cycles over what, 30 years? Don't happen that often. In any case, that's where we are now. So I do think, again, between now and the Fed meeting, the market's going to put in its low, and we are going to have one super good rally in Q2. I plan to use some of that dry powder up during this decline. That again, it's March 7th. The Fed's going to meet next week. We're in that period between now and the 16th where the Fed's going to raise rates, where stocks should find a low. Let's see. Let me finish up with, get rid of that chart off my screen. Let me finish up with two things. I've said them a number of times, but I'll repeat them anyway. When markets go down for more than a day or two, and it's more than a 5% decline, a couple things you can do to help yourself. If you have traditional IRAs, regular 401ks, I always tell people to consider doing a Roth conversion. That means you're going to pay the tax now meaning in April of 2023, on assets that possibly have depreciated. So if you have an account or an asset in an IRA or a 401k that's down more than 10%, I always advocate, or I say I almost always advocate, doing a Roth conversion. If you have a $100,000 IRA, you can do it on a $500 or $5,000 or $50,000 or any amount you want. The benefit is in a Roth, you don't have to do RMDs, required minimum distribution at age 72. One, that's a good thing. Two, your money still grows without paying tax on it. And three, when you pull money out of your Roth, you don't pay tax either. So 3 pros. The con is you got to pay tax on it in April of 2023. And you can't take tax out of your IRAs to do that. You need to have the money aside, or else it blows the whole model up. And two, I keep banging on my desk. This is a great time to harvest tax losses. So if you've got, again, taxable accounts, not an IRA, not a 401k, consider selling Delta Airlines and buying, American Airlines. Consider selling one of your mutual funds and buying a different mutual fund, and you can rack up the tax loss and use that to your advantage on your 2023 taxes. And I don't mean to sound like a jerk about it, but if any financial advisor is not tax loss harvesting and it declines, they should be fired, because that is a sound, very sound practice. And it's one of those gifts that the IRS gives us that we should take full advantage of. And I'm going to finish up with, what did I forget? Oh, March 7th. Look, tax season is tax day is 5 weeks away. So if you, let's see, you should have all received your 1099s and tax forms right now. If your CPA would like copies of your 1099s, just let us know, give us permission, we'll send it out. If your CPA could use a gain loss worksheet in a CSV or Excel file for your taxable account, we'll create it and we'll get that to your CPA as well. Just give us permission, let us know. Other than that, email me, call us, snail mail us, carrier pigeon us with any questions, comments, concerns. Appreciate you watching again. Thank you. And if you like the video, please give it a thumbs up on YouTube. And other than that, I shall be back with more this week for sure. Thanks. Take care.